Roundtable today, sparking a debate about the purpose of a corporation and why maximizing shareholder returns is no longer the main goal.
Indeed, managers, the CEO, have a fiduciary duty to their shareholders to be concerned only with the bottom line. We think this is wrong, a serious mistake.
Today, we're delving into the insightful exploration of the dumbest business idea in history. Business decisions made to maximize shareholder value have resulted in mass layoffs, environmental catastrophes, and a never-ending list of corporate frauds, contributing to record inequality in the workplace. Ironically, the CEO who initially championed maximizing shareholder value in the 1960s later denounced it as the dumbest idea in the world and something that could fundamentally disrupt capitalism. Furthermore, maximizing shareholder value proves to be detrimental not only to the shareholders but to society as a whole. If you despise your job, here's a historical anecdote that might shed some light. In 1916, the Ford Motor Company, led by its founder and majority stockholder Henry Ford, transformed the automobile industry with the introduction of the Ford Model T. Ford envisioned utilizing the surplus cash accumulated by the company to construct additional plants and expand the workforce for increased car production. Notably, Ford garnered attention by substantially increasing factory worker wages and introducing benefits such as the 40-hour work week during press interviews. Ford discussed his strategies for the company. "My ambition is to employ still more men to spread the benefit of the industrial system to the greatest possible number to help them build up their lives in their homes. To make this happen, we are putting the greatest share of our profits back into the business." So this angered minority shareholders in the company who merely wanted him to lower wages, increase the price of the Model T once more, and maintain regular dividend payments. Since Ford was the majority shareholder in the company, their options were limited. They decided to take him to court, but the court sided with the minority shareholders. Ford was obligated to prioritize the shareholders' best interests over his other business ambitions. This case established the precedent for shareholder primacy in America, indicating that board of directors and executives of company must always endeavor to maximize shareholder value to the best of their ability. Some have misinterpreted this ruling to imply that CEOs and the boards that appoint them have a legal mandate to maximize shareholder value. But the reality is that this isn't true. The case ruled in favor of the minority shareholders, but it upheld the business judgment rule, which means that executives can act in what they believe is the best interest of the company, even if it doesn't cause the number on a stock chart to increase. Ford didn't increase wages and create new jobs out of kindness. He was a shrewd businessman aiming to dominate a large portion of the expanding automobile market by offering better pay and higher wages to his workers. He effectively prevented his competitors from accessing a skilled workforce. Additionally, by pricing his Model Ts just slightly above cost, he rendered it nearly impossible for other manufacturers to sell a budget-friendly car at a profit. The greatest irony in this situation is that the minority shareholders who sued Ford were none other than John and Horace Dodge, owning approximately 10% of the company. They utilized their special dividends to fuel the expansion of their enterprise, Dodge, a car manufacturer that would later emerge as one of Ford Motors' principal competitors. Consequently, this court ruling proved detrimental to the company's leadership, workforce, the nation, and the Ford shareholders, who traded market dominance for short-term gains. However, there are 3 reasons. Individuals persist in upholding the belief in maximizing shareholder value, alongside 3 reasons why companies adhering to this principle are almost to encounter failure. Hence, it is imperative to comprehend the workings of money, unveiling how the most flawed notion in business history transitioned into the prevailing standard for corporate America. Corporate America didn't always possess the perilous fixation on shareholder value that it currently exhibits. Even after the landmark Dodge versus Ford case in 1919, companies showed reluctance to adapt. From the mid-1960s to the 1970s, American stock markets mostly traded sideways. Corporate CEOs still had the duty to act in the company's best interest, but their compensation was like that of ordinary employees. According to the Economic Policy Institute and the National Bureau of Labor Statistics, during this, CEOs earned around 20 times the average salary of their company's employees. They were affluent, yet not to the extent where they could retire after a single prosperous year. Their primary motivation was to ensure the company's continued operation, thus safeguarding their well-paid positions for as long as possible. By the 1990s, a small cohort of financiers conceived the notion to achieve growth and garner superior returns from their companies. They should align the interests of CEOs with their objective of maximizing stock prices. It is achieved by reducing CEO cash salaries and incorporating stock options, directly linking CEO bonuses to stock performance. During the 1990s, CEO compensation skyrocketed from 60 times the average worker's pay to staggering 380 times. My friend Patrick Bohl produced an insightful video detailing how this seemingly minor shift in corporate norms ultimately resulted in individuals like Elon Musk demanding $50 billion in compensation for just 1 year's work. With such immense potential for wealth accumulation, CEOs and other senior executives were eager to embrace the notion that maximizing shareholder value was their legal obligation, even if it meant jeopardizing their companies in the long run. Reason 1. The initial approach they employed involved gathering pennies in front of a steamroller. Unsurprisingly, some of the largest companies in the world have taken imprudent risks. We've witnessed some of the most significant corporate bankruptcies in history occurring within the past 24 months, and such occurrences are becoming more prevalent. If you are a CEO with a multi-million-dollar bonus package on table, you will endeavor to fulfill all necessary criteria to secure that bonus. A top priority for you as a CEO will be to increase your company's stock price, offer a substantial dividend, or both. Bonuses typically awarded annually, and according to Fortune magazine, the average tenure of a Fortune 500 CEO is now only 7 years. Therefore, substantial projects with potential long-term benefits spanning decades are essentially futile unless their announcement has the potential to boost your company's stock price. However, even that scenario is improbable, as investors seldom prioritize long-term business strategies due to their infrequent realization. In any case, your optimal strategy should involve managing negative publicity and concentrating on the financial results of that next quarter. An effortless approach to reducing costs is on target areas such as security audits, risk management, safety protocols, long-term planning, and training. By sufficiently cutting back on these areas, you may even boost revenue simultaneously, as sales teams and revenue-generating departments can operate with greater freedom without the constraints of compliance departments to ensure legal adherence. Silicon Valley Bank, one of the biggest bank failures in American history, had a risk management department that regulators described as abysmal. That's among the most severe criticisms financial regulators have voiced. Lehman Brothers filed for bankruptcy because it couldn't resist the revenue generated from subprime mortgage bonds. Boeing's repeated line failures have been attributed to a rush to introduce new planes by reducing safety measures and testing. HSBC, one of the largest banks globally, earned billions in revenue by offering financial services to international criminals. Individuals have faced job loss, depleted savings, and even loss of life via these scandals. However, what becomes even more distressing is that shareholders have incurred billions of dollars in losses from these scandals and numerous others too extensive to enumerate. Yet, the CEOs who ultimately supervise the companies engaging in these detrimental risk trade-offs have already received substantial bonuses, and some have even been granted golden parachutes upon departure. Departments such as risk management and cybersecurity face challenging roles when everything is happening smoothly. Conversely, when things are going poorly, doubts may arise regarding their effectiveness for the business. You may earn a small amount of money by collecting pennies in front of a steamroller, but if something goes wrong, you risk of being crushed, all for a meager sum. Reason 2. The myopic approach of CEOs mandated to prioritize maximizing shareholder value is the second reason it ranks among the worst ideas in the history. It ensures that businesses deteriorate. Jack Welch, who served as the chairman and CEO of General Electric from 1981 to 2001, climbed the ranks within the company from an entry-level position. However, upon assuming the top position, he drastically transformed the company in favor of the shareholders. Welch made 72,000 of GE's 400,000 employees redundant, divested entire company divisions, and heavily invested in the financial and media sectors of the business. GE Capital became the primary focus of an engineering company that manufactured consumer appliances, commercial machinery, and aerospace parts. Welch also spearheaded outsourcing and boasted about it on CNBC, a news network he established to focus on business news after GE acquired NBC. His ruthless strategy proved successful, and during his 20-year tenure as CEO, GE's stock price soared from $6 a share to a high of nearly $370 a share. A year before being asked to step down from the company, he did, but not before receiving an exit package estimated at $417 million. Other CEOs, who now primarily receive compensation in mean of stock options, witnessed this maverick CEO discussing his strategies on his news network and concluded they couldn't dispute the results. According to data from the Economic Policy Institute, the year Jack Welch assumed the CEO at General Electric marked the final year when increases in worker productivity matched increases in wages. Interpret that as you will. Welch's prioritization of shareholders over every other stakeholder in the business yielded favorable results for a considerable period. However, since he departed from the company, GE's stock price has plummeted by approximately 70% from its peak, even amid a record bull market where the overall market surged by 400%. GE was once renowned for producing high-quality products that garnered significant customer loyalty. However, outsourcing resulted in inferior products entering the market, prompting customers to switch to other brands. Moreover, GE, which formerly regarded as one of the most desirable employers due to its stability, competitive pay, and opportunities for career advancement, saw a decline in its appeal. The CEO's proud acknowledgement of mass layoffs and annual termination of the bottom 10% of staff members tarnished its reputation as an employer of choice, causing top talent to seek opportunities elsewhere. By prioritizing shareholders at the expense of customers and employees, GE worsened its situation for all stakeholders. Interestingly, Welch admitted in an interview that maximizing shareholder value was a flawed concept. He asserted that a high stock price is merely the outcome of successfully executing other business strategies. So why didn't Welch heed his own advice? Perhaps because he profited greatly from keeping his benefactors satisfied. During Welch's tenure as CEO, GE consistently met financial targets, almost to an unnervingly flawless extent. Roger Martin, the dean of the Rotman School of Business at the University of Toronto, stated in an interview with Forbes, GE met or beat analyst forecast in 46 of 48 quarters between December 31st, 1989 and September 30th, 2001, a 96% hit rate even more impressive in 41. Of those 46 quarters, GE hit the analyst forecast to the exact penny 89% of perfectly done. Naturally, this wasn't exemplary management. It was traditional creative accounting, a practice that landed GE in hot water with the SEC and contributed to reasoning why Welch eventually asked to depart from the company, albeit in a polite manner. Despite his tarnished record, Welch's business practices are still prevalent in many corporate boardrooms worldwide. All right, you might ask if incentivizing CEOs to prioritize short-term profits has proven detrimental to everyone, including the shareholders who appoint the board and employ the CEO. Why do companies continue to follow this approach? Reason 3. Well, that's because the third reason why maximizing shareholder value is a terrible idea for everyone is that the short term is all that matters. According to data from the largest stock exchanges in America, the average holding period for stocks has been consistently declining for decades. In 1975, investors held on to stocks for an average of 5 years. In 2021, they held on to them for less than 1 year. Electronic brokerages have made buying and selling shares much easier, and people are generally in financial situations that are much less secure, where selling shares becomes a way to cover unexpected expenses. That's not how long-term investing should be done. But staying financially ahead these days is hard. The huge dips in shareholder holding periods happened in 2001 and 2008 during down markets and job losses, where people were probably selling out at a loss on their holdings but needed to cover their expenses one way or another. Long-term capital gains tax laws also encourage people to seek profits from buying and selling year to year rather than a dividend strategy, which can be less tax efficient. As a result, if people are holding onto shares for shorter periods, they only prioritize short-term gains. So, a CEO who delivers a profitable fourth quarter will be more popular than a CEO who reinvests company earnings into training, R&D, or safety, which won't pay off for years. This kind of short-term thinking is not sustainable. Thank you for joining us on this insightful exploration into how this dumbest idea impacted individuals and shareholders.